Alberto, it's good to see you on my podcast. Thank you for your time and sharing your information about secondaries.
Thank
And let me start with an anecdote. When we talk about secondaries, before we dive into your model, I started working with venture funded companies about almost 20 years ago, 18 years ago. It was in 2006. And this was in principle the first time when I heard that people, founders or investors in companies had the idea, especially when we come from tech transfer, that VCs would buy their shares. And the message from VCs was pretty clear. It said, look, we invest in growth, and there are only two liquidity events. One is an IPO, and the other one is an acquisition by name an industry partner of your choice. And that's that. We expect founders and other investors to stay invested until one of these two events happened. And a few years ago, I stumbled over the term secondary. I mean, a few years ago, I think it was 4 years ago during the pandemic. And
you.
this term pops up quite frequently now. In the preparation of our podcast episode, I was listening to Nikolai Tangen's podcast In Good Company, where he had a conversation with Peter Harrison, the CEO of Schroeder. And they both emphasized that the term secondary and that the public markets now, or public market investors, institutional investors, tend to shift towards private markets, especially in innovation, which seems to be a niche that you cater. And also on the All-In podcast from last Friday, Chamath mentioned that he tried to sell his SaaS investments to secondary investors, but unsuccessfully, so nobody wanted them. Um, can you shine more light on what secondary investments are?
So first of all, thank you, Christian, for inviting me to your amazing podcast. It's an honor for me to being here today with all of you. So to answer to your question, first of all, we need to make clear what is secondaries at Giano. At Giano, we do single asset secondaries within digital and tech, which set us apart that most of these secondaries that usually are GP or LP led position. To make it clear,
Mm.
GP led position is when a GP coming to the end of the funds and believe that the best exit for his LPs is to find someone that jump and get the whole portfolio. So in this case, the buyer can get access to a very, very diversified portfolio, can be 20, 30, 50 companies. We are not doing this. We are just getting into a single asset, and we pick carefully single asset.
Mm.
The other side of the market is LLP-led transaction, when an LP, for several reasons, cannot wait the liquidity event and the end of the funds and is looking for an early exit. Of course, this is a little bit less interesting in terms of sizing, but again, you get exposed to whatever is the portfolio of the funds where you are as an LP. So most of our competitors today working on GP and LP led, not only in the venture capital, also in the private equity. We are specialized single asset, digital and tech. And we are a funds that is in the between private equity and venture capital, but later I will tell you why we have this belief.
Mm. That's good to hear. I think the message of you from you is that you basically buy equity from founders, from investors in companies. So single asset is a standard company like Google when it was private, for example, or Facebook when it was private. Just to name a few names. So Facebook would be an ideal investment for you about 15 years ago, 16, 17 years ago, exactly before they gone to public market. What I don't understand, and maybe you can help me understand it better, is what's the advantage for entrepreneurs to do a secondary transaction with you instead of an IPO? How did this market come to life?
Okay, very good question. First of all, IPO today, it's one of the exit opportunity a founder and a board has ahead. We see three main opportunities. First one, of course, is IPO, but bear in mind that it's representing less than a quarter of the exit.
Mhm.
Second opportunities is strategic acquisition. So you have a strategic competitor or company that buy your company, majority or full control. And third one, it's private equity, where today you have a lot of private equity that love to keep company private, they have a lot of money. So those are the three exits. Why our proposition is interesting? Because this three option comes with size. So nowadays, if you think an IPO, and then I will give you the same example for the other two cases, bigger is better. So nowadays, if you want to list your company and you don't want to not having liquidities and not having pricing, you need to have a decent market cap. And decent market cap nowadays, it's 5 to 6 billion plus. Because if you go below 3 billion, the ETF and algos will not buy you. So at the end of the day, you will see very little liquidity. And so the question for you is, why to IPO with all the cost, all the compliance, all the complexity, you then do not see the liquidities and being with the pressure of this quarterly report. So that's the worst. You don't want to see your company as a zombie. So if you go to the other two options, the private equity and also strategic, they also want to come when you are bigger. So this trajectory to getting bigger, just to give you a sense, in the year 2000, people running at IPO, even with an idea, 5 million revenues, with amazing valuation. And we have seen what happened, okay? But now that's not possible. Now, if you want to go IPO, you need to be solid. And to be solid, it takes 10, 12, 15 years. And this is a long journey. After year 8 and 9, there are people that for personal reason or business reason needs, if possible, to find liquidities. And here, what we believe, there is a great opportunities for our fund, for our LPs. And why 8 and 9? Because early stage investors, seed and pre-seed, they're coming to an end of the funds, so they need, and now it's more and more frequent, this DPI. You know what is DPI? And so we have amazing early stage funds with on paper great return, 3 times, 4 times, 7 times, but they have deployed only 20%. So it means if a client has invested 1 million, after 9 years, he returned only 200,000. It's nice, but maybe not great. So to do this DPI, they look more for this kind of opportunities. And then also on the other side of the cap table, you can see founders that saying, okay, let me sell a little bit. Let me de-risk a little bit. Let me increase a little bit my lifestyles. And this also for employees that can maybe buy or start buying the first house, send boys, girls to university. So there are many reasons why this is important. Well, you have to understand why we pick digital and tech for two reasons. A, because the cap table is very fragmented. And two, because at this stage of the company, you can still have a digital and tech growing, which is what to expect, at least 30% in a year. So for that reason, we believe this is a good strategy that A, is really needed by the market, and B, for the investors, can be with a great balance between risk and reward.
That's fascinating. I totally agree to what you say about the IPOs, that especially at the peak of the bubble, a lot of companies went public without a business model, which is pretty odd to see companies listed with negative cash flow from operations or losses and no established business model. So staying private longer makes sense. Before we move deeper into the mechanics of secondaries, maybe we can do some clarification about terminology. What I found interesting is that you mentioned venture capital. On one hand, IPO with 25% of the exits going to the public market. You mentioned strategic acquisitions, which is also clear the company then merges with another company. And for me, interesting is you mentioned separately private equity. And this I find fascinating. So we have VC, private equity, and it seems that secondaries is something in between or completely new. Before our conversation, I would have said, okay, secondary is probably a form of private equity. I understand, for example, Warren Buffett would be a large private equity investor, who buys private companies to just keep them alive and let the management work. What's your approach, or what is your definition of these three different styles, private equity, venture capital, and the area your fund caters into?
Okay, so first of all, the area where our funds stays is an area that you're not considering, as you're saying, private equity buyout, because the percentage of the owning of the company. We are ready to stay minority. We are ready to stay very small shareholder in a very big cap table. We'd rather jump in a great companies that we can own 0 point whatever, and which is not the concept of these big PE firms where they want to have best case majority, and if not, enough minority with a lot of control. The way we see it at this stage, we think that if from 0 to 9 to 10 years, your company is doing 100, 200, 300 million, is growing 30%, is profitable, we rather follow the founders. We rather accept the actual governance. We rather pick the right company with the right business model and follow. The approach of the private equities is different. They say, okay, we want to invest a lot of money, but we want to change things and control. So that's, I would say, one of the main difference. We are more flexible in the amount. We are more flexible in the governance. We believe more in the, I would say, the venture capital system where founders, especially when they're successful, they have a lot of power and a lot of governance, which is still confirmed. The example that you brought, Facebook, as you know, Mark, has not so many shares, but they still have a lot of control. And my personal opinion, as long as doing a great job, why he should not have that, right? So he's providing so much, and the same example you can have with Elon Musk at Tesla is a lot of power, but is bringing a lot of value for the shareholder. So our view is let it do it as long as provide us, what we expect in terms of returns.
When we talk about returns, what's your case? What's your business case for Giano Capital?
Our business case in terms of return, it's very simple. We want to enter in companies that are growing at least 30% year on year. And for us, this is how we call it the risking power. And with that, we want to stay up to 4 years. And because if you do 30% minimum year on year and you compound, you should reach 4 times revenues in the 4 years. And we are happy to make 3 times our money, which then leads for a 20% year on year IRR return for our LPs as a net. So this is to build this. Then, of course, we have a lot of methodology, and that's what we'll talk maybe a little bit later in the evaluation. But this is our target. And we tested these strategies with our own capital, with our family office since 2016. And we had 35 plus IRR, but the most amazing number is DPI. We have 1.35. And going back why funds need liquidity, and we mentioned before, is that because the 2016 venture capital US and Europe are today in average of 0.2. So we are 6 times better. And this proves that this thesis is very short, very opportunistic. And when you pick the right companies, you can have a very early exit with a good IRR.
So it's in principle an interesting opportunity for LPs to go with your fund and to spread a little bit their investment risk. So not only invest in private equity, not only invest in public market investments or venture capital, you offer another opportunity. It's a separate asset class. Is this the right understanding?
Yes, it's totally separate asset class. Yesterday, I received a very interesting question from an LPs. He's saying, yes, Alberto, I do understand you did Secondaries in amazing company, but why should I come with you in your funds and pick this company when they're still private? Why not I wait for the IPO and start having this company once they are public? Okay. My answer was simple as that. When a company is private, they can decide with whom they want to share confidential information, right? So once we have this chance, which is a very important part of our strategies, we never invest in a company if we cannot access to the founders, to the manager, and to have a proper due diligence. So our fund, yes, it's secondary, but we work like a growth fund, like a PE fund. We do serious due diligence. So then when you have access to this information, you have an asymmetric information, you have an advantage. And if you have the capabilities and the expertise, as we have at Giano Capital, to understand what is an opportunities and what is the risk, here you can jump in a company. Then when this company is public, the problem that you have is the kind of information by definition has to be the same for the market. I would say even you take your time to study every public document you can find on this company, you might realize, oh, that's a good opportunity because today the multiple is not where it should be. I expect a growth of ABC, but the risk that you have when you are public is that for the emotion of the market, emotion of like public investors, algorithmic strategies, maybe your view that it could be correct is not going to be confirmed by the market. While when you are private, there is not this mark to market prices, there is not this motion, so you are more safe. So I think earlier it's a little bit better, and B, it's safer when it's private rather than public. So that's the answer. And I would complete saying 2 out of 3 companies will not go in public. So you're going to anyway miss the one that's going to be sold to big PE or strategic acquisition.
This is a good hook point. Companies are sold, so you are a fund and not a conglomerate like Berkshire Hathaway. Can you explain a little bit more your strategic goal with an investment? What do you want to see with the company? What's the end point of your investment? I mean, Warren Buffett, just to give more detailed information, Warren Buffett with Berkshire, when he buys a company, he just keeps them forever, especially the private part. And he's looking for solid companies with strong management that have a business case that lasts forever. What's your goal with your investments? What should a founder and VCs expect when they start talking with you?
Okay, this I think is 2 questions within 1 question. So A, what is our goal, and B, what they expect. Our goal at this stage is to see companies where we have zero risk on business execution. So everything has to be already tested. The only risk we can, I would say, face is that the market will change. And here is our judgment to make sure that at least in the next 4 to 6 years, this is not changing. So our view is to stay in a company up to 4 years. And I think, especially in the digital and tech environment, to stay more than 10 years is very difficult to predict because there are new technologies, there are new disruptive business models that can get quickly to an end to your company. So let me say that Warren Buffett's strategy, with all the respect, maybe does not apply to this industry, can apply to more industrial business. And of course, there is a lot of example where company reach a peak and then for several reasons, they cannot pivot to other business. So this is one. What we want to see extremely strong and capable management team that are capable to execute, they are capable to go to the next step of the company, they're capable to scale, that even they are generating a lot of revenues and the company has a lot of value, they still stay very humble. They are still ready to catch whatever are the signal of the market, that are able to openly discuss with their investors, but with any other people in the ecosystem. Because when you lose this kind of humbleness, here where you might start having a problem. So it's this, of course, then this is also related to have great KPI in terms of CAC, lifetime value, growing EBITDA, cash position, all classic things that any kind of sophisticated investor will look at. What can we bring them? Of course, cash, it's point number 1 when we are okay to invest at certain price. But 2, because my background, and we'll talk a little bit later, as an entrepreneur, I'm my general partner that has been the executive board member at Axel Springer, Andreas Wille. We also always ask to ourselves, okay, we are investing in this amazing company, but what can we do to help them with marginal gains? What can we do? Even we can improve them from 1 or 2% in some area, let's do that. So we sit down and we help them with that. What also we do is that from a relationship point of view, we always share with them the fact that we know that in the next 4 years, when we're going to stay together, they will probably have some issues, some headaches that maybe they will not feel comfortable to share with the team. This is at the founder level, at CEO level, or with the board. They can always come to us because we have been already living some of that problem. And then from a human perspective, they will find a lot of empathy, and B, probably we can get solution, help them to brainstorm and find a solution. And it's extremely important because at this level, this kind of company needs this kind of support. And as you probably know, there is this word, the loneliness of the entrepreneur. It's really true. I live that. And now that I'm on the other side as an investor, I really want, as much as possible, give this comfort to these amazing partners. And this, I think, set us a little bit apart and can unlock very, very good tip discussion. And I think it's a very interesting journey at every level. So return on investment, but also human, because at the end of the day, it's the human part that makes this company great. People, people, people.
That's true. I couldn't agree more. Alberto, before we dive into your amazing journey, let me ask you one or two questions around the European environment. But let's first tie together what you said for the audience so that they really understand when it makes sense to approach you and what are your cases. If I grasped it right, the pre-seed and seed stage are not your focus. Also, the venture capital Series A, Series B stages are usually not your focus. It's the time when companies find their business model, when they see, okay, we have pull from the market, this might scale, and then they test it out with a Series B, probably a Series C. Your point is right before an IPO. So the business model is established, the executive board is established, the team is established, the company has a growing model where they can prove that they deliver 20 to 30% growth in revenue and in the profits. And you have the confidence that this, what they started building, will continue for the next 10 to 20 years and proves to be a solid market. Of course, markets can change, we know that, but this would be the right point in time for you to invest in the company and to say, okay, it's good, we now start the due diligence. So you do a proper due diligence process and don't just buy any equity that comes along your way. So you really dive into it like a private equity fund and analyze the company. Is this the right understanding for your model?
It's the right understanding. However, I want to be precise. We're not a pre-IPO investors because pre-IPO investors, people that coming 6 to 12 months before an exit, and which is not what we want to do because we believe in this position. The only leverage that you have is the multiple, and you are betting that your enter multiple is lower than an exit. And then this has to be also compound with the lockup period. This is what we don't want to do. We want to enter 3 to 4 years before an exit. That IPO is one of the possible exit. And why? Because again, we want to get our return on investment thanks to the increase of the value. And if this come with a higher multiple, this is a nice to have, but cannot be the only reason to make money. So we are not pre-IPO, we are 3 to 4 years. Now, let's see what are the kind of company. It's very difficult to say if we come after Series C, D, I don't care the letter. I don't care because this is depending how many rounds, how many capital, how long it takes you to being profitable. And this is very depending by business. For us, what is important is to have company that generates at least 50 to 100 million euro, better 100 million plus. 50 is in the lower end, growing 30% and being profitable. So if you are in this area, happy to have a look. And then, of course, you need also to explain to us that you are believing, you, the cap table and the board member, that in 3 4 years, you will seriously look for an exit, because this is also important for us because our funds, our mandate is 5+1, and we want to present a very short funds because we believe that in the market today, there are a lot of opportunities in 10+2 or 11+2. And what we feel as LPs, as a family office, that it's too long. We don't want to stay so long. So it's better to have a shorter fund and to make sure I need to stay with you only 4 years. So that's the kind of company. We are not looking too much at how many series. We're looking about other criteria.
And the last point to this fund model at the beginning, we come later to it, is you buy existing shares. So you don't provide capital to the company for growth. You take the shares of venture capitalists and founders. You buy their shares at an agreed price.
In most of the cases, is what we do. But because we know that during the journey we are in this company, they might require additional capital, typically for acquired company, not because the company, if its profit doesn't need, we give flexibilities to our mandate to invest up 30% in primary round. So our way to enter into the company main route is secondaries. However, there is also this primary that can come at the beginning or after when we are already in a company as a pro rata rights. So we stay flexible just to give a good balance to our portfolio.
So you cater basically to one of the biggest problem areas in Europe, in my opinion. I recently read last weekend in Money Week that Europe has as much startups as the United States, but we all have problems with scaling because the capital is not so great. The availability of capital is not so great like in the US. My question to you is, how is your assessment of the European market when we look at the availability of risk capital?
In my opinion, capital is not the biggest missed opportunity in Europe. The problem we have here is that Europe is still very fragmented. So for the companies, it's very difficult to scale in 20 or whatever 27 market because we are still very different in terms of regulation, in terms of languages, in terms of mentality. If you think to do advertising, marketing, especially, you have to, do things differently country by country, and sometimes regulation are so difficult. So for a US investors, is saying, okay, when something works in Miami, it will work in Silicon Valley right away. If something works in Berlin, I'm not sure it's going to work in Milano or in Zurich. So that's the problem. And the capital is a consequence. So this is one. The second, I think also there is not only that, there is also a problem, I would say, of mentality, where by definition, the US investors are much, much more risk taker than Europe investors, where we are more conservative, and this gives us less, less capital available.
Yeah, conservative. What are the three biggest ways out of the dilemma in Europe, in your opinion? If politicians come to you and say, Alberto, give us some hints as an investor, how would you solve these problems that you see in Europe? What's just guess out of curiosity. Is there any way out, or is it just the way it is?
The problem is that we need to stop to think individually as a countries and think as European market. And this, in my opinion, if it's not happening in 5, 10 years, it will happen in 50 years. Because otherwise think, Europe before was a big continent, was a market. Today, let's focus only on our business, digital and tech. We are not considered, because if you think the most successful platform from search engine, social network, payments, everything it started in the US or in Asia, because Asia then put their wall and they do China whatever they want. So you see Europe just buy service from other people, and we have the same amount of people, roughly the same GDP of US, but we're not capable to keep talent. And even when we have a great company, and I will mention one among others, let's say Spotify, I believe if you go to teenagers and you ask where Spotify was created, they will say US because it's listed on NASDAQ. You have no idea that this company started in Europe. So I think everything has to be a little bit rethought at the politician and start thinking about Germany, Italy, Spain, and France. I don't know how, but we need to make sure that we are really one market. and which is not easy, because when you see countries like UK with the Brexit and with everything changing there, and I don't know if it was a right choice. It's not to me to say it, but seeing these taxes increase maybe seems it was not the right one. Uh, we need to be more strong together.
It's interesting you mentioned tech, that we don't have any in Europe. We buy services from everywhere in the world, but don't nurture our own startups. I think it was different in the 90s. Search engines, all these services, they existed in Europe, but for some reason after 2000, with the big crash, I think everything was leveled in Europe and didn't come back, while Silicon Valley kept growing and investing. Also China, Southeast Asia made a huge leap. Um,
There is a
but it,
reason, Christian, very big reason. It's a mentality reason, not only risking. You know what?
it's really
Failure in America, it's part of the learning process. In Europe, failure, it's a disaster, right? So no one will give you back money if you fail with your first startup in Europe, right? It's very difficult. In America, they will say, okay, look, Christian did mistake. Okay, has been honest. Yes. So he learned something and they give you trust again. So if you take it at a very high level, that's why they believe again after the unsuccessful bubble in 2000 that also US suffered. They say, okay, we need to keep going. We understand from our mistakes and we scale it. In Europe, we say, we made a loss. Sorry, it was a mistake. We'll never do it again. And we stop doing things. And here where we miss the train. And you can see we miss the train again with artificial intelligence, right? And this is going to be, if you see our most funded companies in AI has raised, I don't know, a few €100 million, and every newspaper, it's on a way challenging the investor, saying, oh, why are you giving such amount of money? It's a pre-seed round. What are you doing? But if you compare these French companies to OpenAI, they got 10 times less. So they
yeah.
are in the same league with 10 times. So I'm not sure OpenAI will win, but at least has more chances because it has 10 times funding. It can attract 10 times better people, better talent, and make more mistakes, develop it again and again, and probably will get winning the battle.
Yeah, I totally agree. I saw this 10, 15 years ago that the availability of capital in the US is much better than in Europe for founders. So you mentioned Spotify, but for me it was UiPath, the company I invested on when it went public. I invested in this company and bought some equity.
Which one, Christian?
Uh,
Which one?
UiPath, UiPath.
Yes.
Yeah. And on my podcast, I learned with another investor that this company started in Romania, if I remember it right. And I've always thought it's Silicon Valley at some point. I mean, it's listed on the Nasdaq. And I was so surprised. This company had its origins in Europe, but this basically describes the founder story. If you found a company in Europe, it's fine. But at the end of the day, at one point in time, it makes sense to head towards the United States or Southeast Asia, grow the company, and then come back to Europe to scale it where investors like you wait. Would this be a journey that you see?
Not really, because when a company going into the US and becoming a US entity, especially at the holding level, I would say it will be much easier for them to attract US capital. And
Mhm.
for us being a European investors, if we do not have personal relationship with the founder or some of the board member, if we get exposed to secondary, this is going to be the long tail. And usually I say, okay, if this is the long tail, it means that US people have seen things that I'm not seeing at this first page, but it smells bad. So I prefer to focus our effort in Europe where there is less opportunities, so less cash, less supply, and where because we have this extensive network. We live here.
Mm.
My partner is in London. He's very well known in Germany. I've been living in France. So we have a lot of different big countries for digital and tech in Europe where we have kind of, network that can help us to, unlock, I would say, the best opportunity available here.
You mentioned before that you bring more to the table than just investment capital and taking over shares. And during the preparation, I read through your CV and saw that your journey started with 17. as an entrepreneur, and you made some great choices and had some great stories to tell. Can you tell me more about your 17 and what drove you to become an entrepreneur?
Actually, at 17 years old, I realized how life was fragile because my father passed away, and me, I was still at the high school. And here I want to have something to become independent. And here where I start this vibes, this strength, this passion, call it as you want. And then right after the uni at 23, I was wondering how I can become an entrepreneur, and I started actually with no capital because I had no family business to manage, which at the beginning was very difficult, but then turned as an opportunities. As always, I think when you start in a difficult landscape, if you're capable to then, survive, this give you more strength. And here where I started and joining forces with my brother, we bootstrap a group that today it's working with all the fashion leading brands, and we doing several service with them. Now we are a leading position, and thanks to that, then to this success, to this capital, this value creation in 2010, I was seduced by digital and tech, principally because I see people that in 3 to 5 years can create amazing value. And if I compare 2010 to today, this 3 5 years, it turned 3 months now, right? So at that time, I say, okay, look, I need to dedicate as much as possible to digital and technologies, mostly for our next generation, because at that time I was like 37, 38. I was okay, maybe in my case, I can grow our company that is non-digital and I can finish my career happily. But thinking about our next generation, and we at the time we had young kids, I say it's better to start, to look at this industry that seems to be very attractive. And my view is like, when you are outside of a pool and you look at the water, it's always look very cold, even at the sea, right? But then if you are a little bit smart and courage, you jump into, and depending on the real temperature, it takes you from a few seconds to a few minutes to get it warm. You just swim. And this is life. So I thought, okay, from outside it's very difficult. The weather is cold, but let's try to do that. And I enjoy so much the journey. Then in 2012, 2012 and 13, I become a co-founder of a search engine based in France that respect privacy. I become the CEO for 4 years, and this experience of 4 years, I did three things. We were capable to raise nearly 70 million from three big investors. So Axel Springer Group, which today
Mhm.
again Andreas Vida is my general partner. So our friendship, our business relation starting in 14. Then we had European investment banking. We were the first company getting in Juncker plan, and then Caisse de Depot. With that capital, we developed technology. We signed agreement with big corporation like Microsoft, among others. And then finally, we were capable to have this search engine pre-installed in all the French public admin. And here we become a good local success. Now, going back to your question, how to scale it to Europe, I realized that it was not possible to copy paste. So even the French institutional will call the colleague in Germany, in Spain, and in Italy. There is no possibility that they say, okay, let me see how you did in France, and I will copy and paste. So we had to go back to this process, and was a little bit of frustration for me. So then I decided to stay as a non-executive, and since that day, with the knowledge that I got from quant, which in a nutshell is two elements. One is an understanding about the logic of the internet behind the scene. And second, raising this amount of capital from such sophisticated investors make me thinking that I was enough prepared to try to become a professional investor. But then I say, before trying to go to the market, I need to prove to the market, but also to myself. So I start investing our own money into digital and tech. getting exposed to 20 direct investments and more than 10 funds, including fund of funds, just to understand how this ecosystem work. In 19, I've been approached by European investment funds that make a very, very extensive audit and due diligence on me, how I invest, why I invest, understanding what are the logic behind every single investment. And finally, I had this honor and these possibilities to be nominated one of the business angels that work with IF. We are, I would say, 80, 85 people in Europe. And the opportunity for me is that any of my early stage investment or private investment, it's baked on a 1-to-1 ratio at IF. And this for me has been the last achievement in my career that pushed me to say, okay, look, your track record is great. Your, I would say, honesty and integrity is great and is highly confirmed, but having this access to IF with full trust. And I had at that time already find out the beauty of the model that today stays at the heart of our investment thesis, so single asset into secondaries transaction in the digital and tech space. And I was already seeing great return. And I said, okay, look, we can start the journey to try to make available for other LPs. So here I regroup with Andreas Ville and we sit down for a long time and we decide then to launch our funds. It took us a long time to set up and to do everything. But now, since our first closing, that was like July 23, we have deployed in 3 companies, a substantial amount of capital. We are still on one side on a fundraising, on the other side deploying capital. So it's a very exciting journey. And we can prove to anyone listening to us that we are, yes, emerging manager, but because of our experience, because our personal track record, we have been already testing everything. And in the case of the secondary, we test until the exit in the 3 ways that you can see. So the IPO, we can see pro and cons, the PE, and the strategic acquisition. So I think we have enough experience to navigate properly this ecosystem.
That's a fantastic journey, Alberto. Did I get it right? You are open for investments, so institutional investors can still approach you and participate in your fund.
Yes, we're looking for investor. We're looking for any kind of investor. At the moment, we have ultra-net and family office, and hopefully institutional will join. I know that institutional usually are a little bit slow mover. It's part of the life, but I'm not complaining. They know how it is. On the other side, when they move fast with big size. So of course, if any institution listen, I want to welcome. We're going to be here to start to engaging and building relationship.
What's your minimum ticket size that you accept in the fund?
500,000.
Okay, so everything above 500,000, you're the right spot to call to add another investment class to the investment portfolio. Alberto, I have a few questions to your journey. I find it really interesting. You started in fashion with the fashion industry. What made you fall in love with fashion, except being Italian?
Actually, it's been really, really a lucky combination because when I was at the university, it was end of 80s. You probably remember, at least was the case in Italy, where everyone was looking to buy short sleeve polo Ralph Lauren. And I don't know how much you remember about it, but the retail price in Europe was much higher than in the US. And that's because it was a US brand exporting to Europe, and for distribution and other costs, it was much, much more expensive. And back in the days, I realized that there were smart people in US that can get good quantity of polo at domestic price, and there is room for an arbitrage. So they ship this polo here. There is someone that can buy it and take, I don't know, 10% trading fees and resell it to the market. And the people buying here, they're still cheap and they can make this arbitrage. And here what I realized is that this kind of secondary, call it parallel, call it gray market, it's one of the few markets where actually you can do without capital, because usually you can ask to your client to pay you in advance because you are bringing him something premium at a cheaper price than the local. And then with this cash, you keep your margin, which technically is a commission, but actually become your margin because he has no clue where you're buying, and your supplier has no clue who is the client. So you control, the whole chain, which usually when you are an intermediary, because you are not putting capital, you lose the control because you put together the two people, they pay you commission maybe 1 or 2 times, and then they say, okay, look, I cannot pay you again 10%. And this is where I like this business, and I started in fashion. But this can be applied to any secondary market. It can be in watches, can be in car, can be in a lot of industry. And we started because without capital, it was one of the few opportunities to scale without capital, make your margin. And then the second step has been to saying, okay, look, now it's good if we invest our capital, and here where we maximize profit, into inventories. So in fashion, at the end of the season, you need to keep the goods for 6 months and then recycle in outlet. But outlets are not enough because, as you know, outlets is 1 year older goods and they come with a discount. But usually brand has much, much larger quantities. And here where we come, we buy this larger quantity with a good discount and resell it after through different channels. And here where we maximize our profit. So that's the two reasons. It started by necessity, but I think, again, being in Italy was the right spot because we have a lot of brands. We could get a lot of access. So always it's a combination between needs and opportunity.
Yeah, I remember I grew up in Styria in Austria, driving to Italy to buy fashion with my parents. So it's this was the 80s for me, 80s, 90s, and early 90s. Fashion, I mean, you basically were the Gary Vaynerchuk, the European Gary Vaynerchuk of the 80s. You flipped, in principle, you flipped goods. Would you agree to that?
Say it again. Sorry, I missed the question.
So Gary Vaynerchuk is a European, a US influencer that
Okay, I don't know him.
yeah, that his story is that he started with flipping goods, basically wine. He sold wine and started to sell wine over the internet. And he always recommends young people, if you don't have money, flip goods. So
Yeah.
basically buy stuff somewhere in the world and then develop a nice story and sell it over the internet these days. And I said, ironically, a little bit that you basically were the Gary Vaynerchuk of the 80s in the fashion industry. You did basically this model that he suggested. And the reason is for young people still today valid. When you don't have capital, connect people, basically buy goods and tell a nice story and sell it via the internet or in real life to other people at a higher price, and you can make a nice margin. Is this still possible today, in your opinion?
No, it's still possible thanks to internet. And in 2008 and 10, we started experiencing that there were a lot of individual selling goods on eBay. Of course, today the market has changed, but it's still possible. There is always an opportunities to make money in the right industry with the right prices, the right access.
And was this the reason then that you pivoted towards the tech world, the dynamics in 2008, 2009?
The reason was that we were seeing this wave in our industry about, you know, uh, special sales like Vente Privé, Privalia. We were seeing eBay, we were seeing Amazon arriving, and we're saying, okay, look, we believe that the big market will be there. And also another things that we've seen back in the days, it was that if you think on a product, right? And if you think you are localized, let's say in Paris, everyone in one district give to this product the same value, the same price because you see in those windows. But then you don't know on the other side of the world, in Silicon Valley or in Japan, the same item can worth 20, 30, 50% higher. So then this is the beauty of internet. So another reason was for me saying, okay, look, there is something that here we price it 10 bucks, but there are people in Japan that can buy it at 15. So if through tech, through internet, through e-commerce, I'm able to reach, I can make more profit. So that was one of the easy reasons. And then jumping in the search engine was a reason to say, okay, but if I'm successful with that, I can have really part of control of this ecosystem.
Mm.
And thanks to that journey, I understand a lot of things behind the scene about the data. I'm not an engineer, but I clearly understand several business model, how they can be, made possible in this industry, thanks to what I've seen, co-founding a search engine.
When did you start with the search engine?
In end of 2012.
I'm curious, what motivated you? I mean, in the 90s, there were a lot of search engines. Then Google came along. I think they started 1997, 98, got venture funding in the early 2000s. And I think in 2012, Google was already the biggest on the market, the biggest search engine on the market, and basically wiped every other search engine out. What I mean, it's a similar story like the iPhone. I mean, it was also surprised that Steve Jobs in 2007, I worked in the mobile industry briefly, was surprised in 2007 that Steve Jobs put another mobile phone on the market, and the success proved him right. What was your thesis in 2012 to put the search engine on the market when Google was so dominant?
Two reasons. A was to try to tackle uh, the European appetite to get back sovereignty. This is one.
Mm.
Two, anticipate this privacy topic, because back in 13, when we really think about search engine and what should be our position, we were ahead of the time and we say, okay, look, privacy is something we need at some point to care. And as you see, Europe was an early adopter, and we were the first search engine on a full privacy base. Okay. And I think that we could be much more successful if we were in a market where every country was, trying to help each other, as we saying now for other business, right? So our success has been limited by, I would say, the fact that every country is looking at its own, uh, strategy, vision, and mission. Otherwise, if we could scale from France to the 20 countries,
Mm.
it could be a really a European champions and success, which
Yeah.
stays still a question if this is doable or not. But that was the vision, and for us, has been a successful investment and journey, but has been very small compared to the big picture that we had back in the days.
So your USP was privacy with the search engine. Yeah, yeah, I think this is an important part now in 2024. I mean, I agree totally to what you say about Europe. I think we still grow up with the stories of the European empires from 1700, 1800 something, but the world has changed, and Europe needs to unite and become a single market if Europe wants to stay relevant. I'm still surprised that France and the French are proud about France, the Austrians about Austria, the Germans about Germany, and that we all have this localities, which makes it difficult and challenging and bureaucratic to roll something out in Europe. If you can access the market all at once, like in the US, one language, for example, if you could agree on English, one system, one financial market, one capital market, it would be much better for the startup world.
Absolutely, but not only for the startup, for everyone, for any company can scale easily from Germany to France to Spain to Italy, and and one VAT system, everything digitalized can be really much better. I hope that something will change in a few years, but let's stay positive.
Yeah, that's true. I mean, the tech has arrived, so we just need to use it. We don't need these complex systems anymore. Uh, I'm curious. You went from fashion to tech, and then to finance. What was this turning point in your journey that you said, now I go from the search engine business, which of course truly has potential. I mean, it's world and privacy is a topic, and there is a lot to. Uh, why did you decide then to go into, I mean, it's the third part. It's completely different. It's fashion, it's tech, and finance. What made you shift your mindset?
So first of all, when we start raising capital, I start looking how this industry works, and then staying closer and getting the attention of Axel Springer, which has been, I would say, the largest and the most sophisticated investing in Europe, invested in, I don't know, a lot of companies, several billions, opened my eyes to this industry and these opportunities, right? And then it was, for me, it was clear that I have to start this with our capital. So I say, okay, look, let's start to see how you can make profit out of it. And then when I realized that we were good, I say, okay, let's work, let's make it a full-time job. And this also meet my passion, because me today, first of all, I'm doing that again as when we started in tech for our next generation. I have two boys, my brother had three boys. So in total, we have five young boys from 23 to 12.
Mhm.
And so opening for them opportunities, I believe digital and tech is going to be one of the routes. That was my one of my levers. And then I would say I have so much fun today, because on one side, for me, most of my colleagues saying, "Oh, I really hate fundraising." Me, because I started as an entrepreneur, I love the fundraising, because I love to sit down, having coffee, discussing with ultranet, mainly family office today, but tomorrow can be also institutional, and hear and get to learn what great journey they had, share what I know, and get exposed to what they know that I don't know. The other things that I like is always connecting people, connecting the dot. So what we do at Giano, and our investor day has been the first case, and we had 100 investors from Europe. And what we did a couple session of speed dating that it took us a lot of effort to make this matching. But then to see all these exciting people from London connecting with Zurich, because we know they have in common, I don't know, real estate strategy or passion. And it was simply amazing. And we're going to go more and more. So this is one side of the market where I'm still very, very passionate. So fundraising for me is not an issue, actually is an opportunity. On the other side, investing in such growing and big companies like the one that you can see in our portfolio, it's exciting. Sitting down with this top level management that explain you what they are going to do in the next 12, 24 months, 36 months, new product, new feature, how they're going to maximize the value of a client. For me, it's a lot of exciting and keep me really passionate and young. So I see it as what helped me to wake up in the morning with smiling and being very happy.
And it's very long term. What I found interesting in the questionnaire, I have a questionnaire to prepare for the podcast that every speaker has to fill in to give me some information about them. And you described yourself in the questionnaire as ruthless in the pursuit of goals. What drives you? Why do you describe yourself in that way?
First of all, I am very, very challenging person, and I challenge myself a lot, right? And for me, I always try to keep a balance between where am I and where I want to go. But I'm very ambitious. So everything I do, I want to try to do as best. I'm not a generalist. I do a few things, but I try to focus as much as possible. Everything stays out of my focus. I have no clue. So sometimes people, we go into dinner and say, have you heard about this? And it looks like I'm not living here. I say, oh, what's happened? You know? And on the contrary, if you ask something about what is my business, what is my passion, which is nowadays in the last 12 years has been cycling, right?
Mhm.
I can tell you, I would not say everything, but a lot of things, because every day I'm focused. Every day I try to learn. Before you mention about all in, right? I think that today we are very lucky. We can listen to amazing podcasts, you're among others, and get, you know, exposed to amazing people that even for 30 seconds, for 2 minutes, teach you something. And
Yeah.
if you are capable to stay focused and careful, you catch something, and this can then give you ideas and give you knowledge, right? So, and really, I was listening all in, and it was funny to hear Chamat saying I cannot sell my SaaS company.
Yeah.
But reality is that secondary investors are not stupid. So if they're not buying his SaaS company, it means that there is a problem, right? And he knows it, and that's why he's making fun about it. So that's me.
Well, I mean, focus is good in business, generally speaking, but what does that mean for founders who want to work with you? Do you focus them in the same way?
No, everyone, especially when you are a successful founder, has his own recipes. You cannot think to change people, right?
Mhm.
You can give them friendly advices and do not expect they take 100% of your advice. If they take 25%, it's a nice increase. So no, my way to see things is to always let, as long the people are doing well performing, everyone has his own approach, his own lifestyle, and actually the diversity make us richer. So I'm able and I'm happy to share what is my belief, what is my strategies, but I do not think fits for everyone. So I'm happy to let the founders, the board member, or any person in the company to work as he thinks, to act as he thinks, as long the result is on his side. And if it's not, let's sit down to discuss how we can improve it, but always keeping the right balance between, motivation, emotion, and accepting that everyone is very different.
So on one hand, you are ruthless in the pursuit of your own goals and very focused and ambitious with an excellent leadership understanding that when founders scale the company already to a successful story that they become interesting for your fund, that you let them live their strategy, but are always open to have a conversation with them if they need in coaching styles some ideas, what worked in other industries, and pitch ideas with you, ideas with you, what can be transported to their company and how they can make it better. But you don't come in as the ruthless Italian pirate who takes over the company and then shows people how they can win.
I'm ruthless with myself, not with
Yeah.
everyone else, only with
Okay.
myself, right? And but everyone else, on the contrary, I try to understand. And again, the expectation is that when they take 25, 30%, that's more than enough. And I never take things personally. So again, another point that changed my career, when you are an entrepreneur, especially for me, at least early days, you stop being a one-man show, and then the evolution is okay, one-man show, it's capped, let's be 2 3 one-man show, then 30, then 40. And then when you become a co-founder and you have public money, you understand, for me, governance, it's an opportunities, because it's true that you are not free to do everything. That's true. However, if you take the other side of the coin, as everything in the life, if something happens, the mistake is shared. So I don't want to listen. I'm a CEO. We are on the board. We decide to do one strategy. If it doesn't work, okay, I put this strategy, but you voted with me. So we have to think that. And the evolution when you are an investor is saying, okay, A, it's never personally. B, you are one out of many here in the room. If you bring smart ideas, interesting topics, probably if the founder will not get it, the other investor will get it, and we help you to make the founder seeing what you see. Sometimes it's a question of perspective, and we don't see the same things at the same moment. So I accept it, and it takes time. And being an investor and being a board member, especially supportive, it's also like this being very, quiet, waiting. It's a little bit sometimes like politics, okay? You cannot think Monday you have an idea, Tuesday it's realized. You need to take time, and I learned by the experience, but I think it's part of the game.
Yeah, especially when companies are bigger, it takes time until ideas come to fruition. I remember my time in the merger acquisition. Startups usually can move fast, but the bigger the organization gets, the longer information needs to disseminate, and that results are showing up. When we come back to your fund in the discussion, you mentioned that your fund is positioned in the late stage. Not pre-IPO, but before an IPO, and IPO is a potential exit scenario. And one reason that you said why companies should come to you is IPO is much more difficult. You have a different governance structure, and private is easier. What are your expectations towards governance as a late-stage fund? I mean, it's not completely like it's on public markets, but what is your minimum requirement?
Okay. In governance, I think more we could focus, of course, governance. We see what is the actual shareholder, and usually we have no ways to impact and change it. So either we accept it or we say no. Most of the cases we say yes, because nowadays, especially at this stage, those company has already polished this shareholder agreement because you have sophisticated investors before us. And actually, this is another good signal. We want to enter in company where we see at least tier one investors that usually have this good balancing governance. What we expect more than that, because this is, let's say, on the due diligence phase, we say, okay, we like this shareholder agreement. We know what are our rights. That's fine. What is very important, I think, is the reporting system. So how you can track your investment, how you can track company performance, how you compare actual performance to budget, that then this give you the opportunities. If you think things where you can give help to the company, you can ring the founder saying, okay, look, I've seen a decrease of here, I've seen an increase of cost here. What is the problem? How can I help you? So reporting is very important. I would say nowadays I'm quite impressed with some companies, how they are becoming very good in reporting, becoming very transparent. And some of the company now they do some report that I would say they're not too far from a public companies. They give you enough details. They invest money to have 2, 3 people to dedicate to this, extensive reporting. So for us, important reporting. For us, is important to have, 1 hour per month to discuss with, I don't know, the CMO, the CFO, and things. And so that's very important for us. Access to the management.
What I liked before in the personal section is you mentioned the All In podcast and how amazing it is today to access information via the internet, which your colleague Maurice is joining. I will just say briefly hello to him if he joins, and then move him to the attendees so that we have a clear stream. I think it takes some time to join. That is, maybe I move him directly to the attendees.
Okay.
Let me just check where I can do that. It's here. Change role to attendee. So then we have just a clear recording and a clear frame.
Yes, sure.
That is better for the post-production. I hope he doesn't mind. What I liked before, you were talking about the All In podcast and how amazing it is today to access information via the internet. You see excellent investors and entrepreneurs on podcasts sharing their real journey, real information, real stories, and especially in business. I mean, starting business is a social science, so not everything what works in one company works in another company. You just need to find the bits and pieces and stitch them together. Remembering the 80s, it was completely different. It meant traveling, the ecosystem were more local. It was really hard to get access to investors like Warren Buffett or you. I mean, thinking back to the 80s, we would probably have never met directly. A podcast was impossible. But there is one downside with this dissemination of information. Trends are everywhere. And when you think about the last 10 years, everything was about startup. Everything was about the startup world, especially the All In podcast is still podcast dedicated to the startup world and scale-up world. What motivated you in this noisy world where everybody talked about early stage startup investments to say, no, my fund is not becoming a startup fund or a super angel fund. We go into the late stages. Why did you and your partner decide to become a late stage? Nobody's talking about late stages on the internet. Why did you choose this contrarian way?
First of all, because we believe the risk reward it's much better. B, we think there is a big demand in the market. C, we think that when you are ahead of the time, it's always better to take market position. For all these reasons, I think is the best choice. I'm not saying to being an early stage investor is not good, but the market is so crowded. And there is another reason that I like is that our business, it's not related to be local. What I mean with that is that if you are based in Berlin, you probably could meet the next successful founder if it's raising its company startup in Berlin. But if this guy is probably in Paris, I don't see you, Christian, meeting this guy. So when you are a late stage investors, there is a lot of public data. And even not in Berlin, if I don't know, let's make the example of Get Your Guide is successful, I can always take a flight and going to visit Get Your Guide management because from even far, I can see how good is this company. So for a lot of reasons, we think it's interesting, our ecosystem. But of course, this ecosystem cannot be possible if there are not early stage investors around BC. So it's a whole ecosystem that needs to work, and everyone has to pick where you want to stay in the market.
Yeah, I think you found a great spot because I think the need is there, and there are not many people in this area, and this is something that I criticize when I look at Europe. I criticize it constantly that we have a lot of early stage investors, but after Series A, basically the market in Europe is dead. And my usual recommendation to founders is when they want my advice, look towards Dubai, look towards Saudi Arabia, look towards the United States, Southeast Asia, which region you prefer, choose one, go there. And it's not Europe. And you close a spot on the market, in my opinion.
Thank you.
And it's an important work. When I look at public market investments, I mean, the research is quite simple these days. You have the internet and they have a governance structure and needs to publish reports frequently, and you can get a lot of information. And when I read about public market investors, they usually prefer solitude and say, okay, I don't want to go with the crowd. I need my space on a mountain, and I'm more like a monk and do my due diligence at home with information from the internet. When I look at the VC style and I read through the literature, it's pretty clear VCs are out on the market, constantly hunting for opportunities and need to go where no information is available yet and find the founders and interesting ideas. What's the secondary style when you look at your research? How do you access the market? Are you more on the public market investor side and are more passive in your approach, or do you pursue more an active style like a VC or something completely unique?
We say we are in the middle because we can access to a lot of information, not maybe as much as public,
Mm.
but we have this advantage to being able to access to a certain level of information. And we are like the VC because we need to hunt this opportunity because on the public market, everyone can access. You call your bank and they say, okay, buy for me this stock or sell this stock. So we are, I would say, in the between.
How active are you? You said you hunt for the opportunities. How can just describe a usual process when you found an opportunity? How does it look like?
Yes, that's a very interesting question. So first of all, you have to know that in the last 12 months, Giano has been received between inbound and outbound over 100 opportunities that from from the outside fits our criteria. Out
Mhm.
of it, we have been in a certain level of detail that could make us capable to fill our proprietary scorecard 42 companies. Out of it, we have invested in 3, and in the remaining that are 39, I would say we have still 25, 26 that we believe can have kind of interest between 6 to 18 months from now. So just give you a sense. To reach this level, what we do is, of course, we're starting to have our brand awareness. People start to know Giano Capital, especially we have been having good relationship with top M&A, bank, small boutique within Europe. So everything, when there is a primary with the secondaries, they ring us saying, hey, Giano, are you interested? That's one side, but we are very active in the market. So what we do is that we have today over 300 companies in Europe under our radar. And then we'll look at signals where we say, okay, the maturity of the companies, the length of one investor in this company is 10 years, 9 years. There are a lot of signals. And then we approach the company. We look, okay, how can we approach the company? The ultimate goal is to being capable to sit down with founder and CEO. So can I get in touch with him through a friend? to an investor, through a board member, through a lawyer. Everything is possible to keep and open this door. And once the door is open, it's our role to get engaged, to spend time together, to start this due diligence, to know each other. And this then at the end of the journey, after due diligence and relationship, leads to they're happy to have us in the cap table, and we are happy to be in the cap table.
You have a 3% investment rate. So from 100 companies that you get into your deal funnel, you invest in 3. Is this generally a general statement that's possible? Can you generalize it that way, or is it just from this first 100 batch?
No, because remember that we still have 25, 26 companies that are still in the kitchen. So I
Yeah,
cannot
yeah.
say 3. I can say much more than 3. So it's not 3%. And then also you have to think that our funds wants to have a very limited number of position. We think 10 to
Mhm.
12. So we don't need to scale to 100 position, because at this stage we want to have 10, 12 solid companies and focus our effort to help them rather than having 100 companies. And here we are a little bit like Warren Buffett. We like some position, we stick with it, and we have highly conviction. We don't believe in a very, very highly diversification.
Do you reinvest in companies when you see that a company works really well and it makes sense to keep it private? Would you be up to reinvesting, or is it a one-time investment and then comes the exit right after?
No, no, we are open to invest, especially in the secondary, because it can happen that we invest in a company after 6 months, the founder ring you back and say, okay, look, I have for ABC reason another needs. And if we agree on the valuation, it's going to be very easy to write the check.
Mm. That's good to know. That's good to know. How important is community and relationship building for your fund?
It's extremely important. What I like in our industry, it's that it's an industry where there is a lot of sharing, right? And information circulate. There is this sharing, which is a little bit different than in PE, because PE, they're competing for the same deal, and there's only one winner. In our industry, I would say we can share this winning and we share the risk. So building the community is super important at every level, from LPs, from bankers, from GPs, and from founders, from board members. So we really, really try to engage as much as possible and build for every community the right approach, the right track record, which at the end of the day, our goal is to, in the next 5 years, being called at least 90% of the time there is a secondary transaction in Europe. So that's our goal. We want that when there is a secondary transaction, 90% of the time, they will send us an email, they will send us a call, and they will say, okay, look, can you have a look? Then doesn't mean we're going to invest, but at least we have a full, access to the market.
Now you close an important gap on the market. You keep the European companies longer in Europe because, on the other hand, I mean, if you don't exist, they would need to jump ship quite a lot earlier. I mean, when a company gets in US investors on board at the end of the day, I think the road is clear to the United States. I see it. I mean, I worked mostly in biotech in the last decade, and I saw it very often when a US investor got interested in a biotech company. 5 to 6 years later, the company had its headquarters in the United States and listed in the United States. So your work is keeping European companies in Europe.
I would say that our work, I don't know if keeping the company in Europe, but for sure, I think give a little bit of relief to founders and board member when they have people in the cap table that getting stressed and won't getting out. So this it's an important thing. I think if you are a founder and you have an early stage investor every 2 months calling you in his DPI, in his DPI. So if you can get rid of these investors, you get this DPI and you replace it with us where we're supportive. This is a typical case where I give relief, which is the same if you have like people that are pushing for a little bit liquidity on the stock option plan, and you as a founder, you want to them being motivated, and if you give them like this 10% of stock option plan liquid, make them more happy and you are more happy. So this, I think, the main goal, rather than keeping the company in Europe. That can be the case, but we have not such big impact, to be honest.
How is the support from Brussels for your stage of investment? I mean, I know that the European Investment Fund invests very heavily in early stage fund or in fund managers who go into startups and early stage scale-ups. How is the support of AEF for the later stages? I always thought that there's not so much support in this area. It's just for
Uh,
me for information.
yeah. I'll try to answer this question with two answers. I have just launched, I don't know, 1 year ago, 18 months ago, a big fund for late stage
Mm.
because they realized what we were sharing that at this stage, a lot of company going to US. That's great. However, they are not having a specific mandate to work within our strategies. We've been talking to them, and probably this mandate, I hope, will come soon because this is again a loop that has to be, at some point closed because keeping your team motivated, keeping this DPI in the early stage investor through secondaries without pushing the company for an early exit when they are not ready. It's super important for all the ecosystem. And I think we are not far to get there, but not yet.
I had David Dana on my podcast about a year ago, and we were talking mostly about startups in the early stages. And it's good to see that in later stage also the AAF is closing the gap. It's super important for the taxpayer. I mean, we invest a lot in research and in early stage development, but when the companies then move to the United States, my personal opinion is that most of the tax returns at the end of the day then happen, of course, in the United States and not in Europe, which is out for the taxpayer. And also your fund and your strategy is super important to help the companies grow in Europe, in my opinion.
Agreed, 100%.
So I hope that the AF is listening and is doing something at the end of the day. When we go, I mean, your fund and your experience is there, you invested. Can you walk us through a success story from your fund so that people can see and hear how it looks like from the first engagement to your investment and how the company then evolves? If you have one company or so that we can walk through, it would be helpful, I think.
So I can give you the example of Get Your Guide, which is an extremely successful European companies. And I would say 8, 9 months before we close our investment, we start discussing with the founder and CEO the needs of this secondary process. And we were very early engaged in the process, discussing about the opportunities and how we could approach it. And then we were one of the first investor believing on this potential secondary transaction. And we are very happy because since that day, the company is still keeping the pace, growing, helped grow, and we see really a very good future for the company and of course for our investment. So that's one case, and the second case is just happened with a company named Revolut that we invest as with our fund, but we were already investors on a club deal basis when we were testing the water for our friends and LPs back in 21. So we can see even with a crisis, even with a lot of difficulties, Revolut could increase the evaluation from what was in 21 to 24. And this answer to a question that is okay, what's happened if you pick the wrong moment investing in a hype and then the market going down because you deploy the capital so fast. And Reverie is a good example. We had our first transaction November 21, I would say at the peak. And then here, 3 years later, the company had got like 50% more in valuation. And I think there is a lot of value to be unlocked. And this shows and proves that if you pick the right team with the right business model, with very good capability to execute, you can always, with a little bit of patience, you can always get a good return on investment. We always think and dream to buy cheap and sell expensive, but we never get the peak in both sides. So let's try to accumulate position with high conviction. Let's
Mm.
bet on people, on business model, and let's be a little bit, when needed, a little bit patient, and the return is there.
When founders or VCs approach you from the first engagement to basically closing of the transaction, What's the timeline they should expect when they start working with you? So when they send the first email to you, are we talking about 1 week and money is wired, or are we more on a VC case 12 to 24 months or longer?
Okay, let's say that I like to consider as a starting point when we agree that we can access to the information. Everything else is a preparation that can take 1 day or 6 months. So once they saying, okay, look, we are ready to open you to a data room,
Mm.
it will take us, for us to complete our due diligence, I would say from 3 to 6 weeks to go into our committee. And if we say yes, from that time, it will take another 4 to 6 weeks for closing. So I would say anything between 2 to 3 months to close an investment process.
That's a fast turnaround. So when you're interested and when they are ready to open the books to you, it's about a quarter that
Yeah.
everything is sealed or turned down. I mean, it can also be some material findings at the end of the day. There's no guarantee with a due diligence that the deal closes,
No,
but
we need to approve the investment, right?
yeah.
So once we approve, I think it's 2 to 3 months.
I think this is sometimes important to mention that the due diligence is not the agreement. So there's still then something at the end of the day.
Not at all. The due diligence is the starting of the journey, not the arrival.
That's a good point. When I look at what I found appealing in our conversation in the preparation is that you mentioned that you do a lot of cycling and that you really like sports and do a lot of sports and also gym, I remember. Um, when we talk about leadership and building companies, what's your opinion about leadership and sports? Why is that important for leaders?
I would say for several reasons. The first one, there are a lot of lessons from sport that can be learned and applied in our day-to-day life, not only in business, but also with friends, with family. So that's one. And if you want, we can go deeper in details. And two, at a personal level, I love to do cycling, but before I was in love with tennis and other sport when I was younger. And I would say every age can have different, sport if you want to change in life. But sport for me give you the opportunities to clean your thought, clean your mind, getting you fresh air. Sometimes, especially in cycling, being capable to manage your emotion, your frustration, and you start with a new page, smiling page, white page, and also cycling. I love it because especially when you think about climax, it makes you understanding and accepting the difficulties, but understanding that 20 minutes after, 30 minutes after, 1 hour after, you're gonna get the flat and then the descending. And this is everything in the life. There are days where things are very difficult and the easy way is to give up, but I don't think it's the right way. And like in cycling, you need to reach the top and then, you know, you're gonna have the descent, a lot of fresh winds, a lot of relief, and a lot of happiness because you should be then proud of yourself. So on my WhatsApp, my picture is nothing truly great come from a comfort zone, right? And for me, because I'm again ruthless and I challenge myself, I always try to stay a little bit outside from my comfort zone. And here where there is this mix of emotion where I like it, but I need to push myself. So, and this is how I see things and why I think sport is so important. And if you see successful entrepreneur, founder, investors, most of them dedicate time to sport with, I would say, this kind of, approach as I described.
That's true. Alberto, we are coming to the 90 minutes mark, and I would like to ask three final questions, if that's fine with you, for the
Fine with
last
me.
5 minutes. Um, you said sports teaches a lot of valuable lessons to leaders. If one leader is listening, and I could imagine that some of them, yeah, but I haven't done sports in my life yet, so why should I start now? What are these lessons? What would be the three most important lessons that you could tell them to say, okay, these are the lesson number 1, 2, and 3, why you should consider doing something like cycling or running or playing tennis or playing football, whatever they like.
Okay, first of all, if you have never done any sport, if you even start today, it's not gonna be the performances that make you happy, and it's gonna be not the performances and the result that make you a better founder. Is the approach. So we are not professional. We're not professional in cycling, in running. We are amateur, right? So it doesn't matter if I can do, let's say, the New York Marathon in 3, 4, or 5 hours. I don't care. We are the same. What I need to get out of the marathon, let's make this New York Marathon, which is one of the main objective of people in life when they do running, right? Is you understand how important is your preparation. Usually it takes 6 to 12 months. And then when you go deep in the preparation, you know that you have 2, 3 things to consider. Of course, the training, which means how many hours per week you can dedicate. And then B, if you're a little bit more sophisticated, you say, okay, what is the quality of my training? C, you're saying, okay, can I have a coach or not? Then there is another part of preparation, which is nutrition that comes with, I would say, diet, weight losing, then coming with integration, where you're saying, okay, after I'm running 20K, I'm exhausted. So you need to integrate. And then finally, also to manage your expectation, your frustration. And then it comes to the day to going to run this marathon. If I'm not wrong, Sunday, there is New York Marathon, and then let it go. And this is like your business, right? It's preparation, mentoring, getting people that know better than you and can help you to navigate. And then you let it go. You manage your frustration, you manage your emotion, your expectation. You also accept in a long marathon, 42 kilometers, that there are like 4, 5 Ks where you feel very tired and you think, I'm not going to go to the end, right? And we are 31, 32, and you say, oh, look, I still have 10K. How can I do that? But experience, I can tell you, will show you that maybe at 37, you are much, much more energy than at 31, which you will never believe and thought about it. This is, again, in business. Sometimes you are, devastated. You say, oh, think that's very difficult. I cannot see the light at the end of the tunnel, but you see it and it's there. So it's kind of lesson that sport teach you. And then when you have this belief, everything gets more easy because you're doing with the right approach. Positive mindset and smiling will help you in difficult moment.
I couldn't agree more. It makes sense for leaders, especially in business, to add sports to their schedule and make time for it. It's absolutely good advice.
Can I add something?
Yeah,
Now,
sure.
for leaders that thinks that while they're doing sport, it's lost time, I suggest to do what I'm doing recently. Use your sport also to listen to podcasts. So what I do, I like to do indoor cycling. Sometimes I listen podcasts. You, Olin, or whoever. I run outside in my park. I listen to podcast. So at least I get exposed to a little bit. Maybe sometimes I listen carefully, sometimes less, but at least I don't feel guilty. And then when you think that you don't need that, just go to take sport, breathe, and relax.
I totally agree. When I run in the morning, I do one way. So the first half is without music and without podcasts. And what I find amazing with cycling also is that the mind starts sorting out things, that the mind starts automatically, it's like an automated process, starts sorting through things, gets rid of things that are not so important, starts focusing on the important things and always comes up with a solution. And the second half, then I do this, what you suggest, plug in the podcast and run back with some information in my mind. And there's always something to learn.
Absolutely. I agree.
Alberto, where do you see Giano Capital in 10 years? What's your long-term vision for the fund?
The long-term vision is, as I mentioned before, to being able to see 90% at least of the secondary transaction in Europe. We want to develop, of course, our AUM, but we want also to build, and we just started, a trustworthy communities of family office and LPs. And we have started this year with our investor day in September, where in Monaco we had 100 LPs coming from all over Europe. And we start connecting them. We spend a lot of time with our LPs and prospects to get to know each other because we believe this is again kind of personal connecting, where especially in a fund like us, where an LP is a family office can have direct access with the GP. There are many things we need to know each other. And then once I get exposed to them and I know them, I can then connect with other people. And this for us, it's very easy because being an entrepreneur, one of the quality you must have is connecting the dots. So this is what we love to do. And so in 10 years, we want to be in the biggest communities, and people would like to stay with us for not only the economic return on Giano, but also with this big community of family office and ultra-net.
Yeah, community building is super important, and podcast is an excellent way to do it and to accelerate it these days. I come to my final question. When we look at your journey, I mean, you have an amazing career. You have seen a lot of different industries, especially now with your fund. You're talking with a lot of family offices, a lot of LPs, a lot of institutional investors. You saw retail, you saw search engines and tech, the finance world, and I'm sure you learned a lot of lessons. In the last part, in the last question, what's one lesson that stands out and that you think helps entrepreneurs one step forward?
I would say resilience, because in any business, it's a very long journey. Every successful business has been obliged, if not completely pivoting the first or the second business model, to adjust it. And when they did it, it was as a jump in a black hole. So do not at that point in time believe that because you're doing that, you did something wrong. Right? This is part of the journey. So resilient, stay confident, stay open to new opportunities to advise, staying humble. This is what I think make you a successful founders and entrepreneur.
That's great advice at the end of the podcast. Alberto, thank you very much for being part of the show. I enjoyed every single minute of it. And let's catch up in a year or so and see how your fund evolved.
Christian, thank you very much. It was my pleasure. And I hope to see you in 1 year and get here another 90 minutes with fresh topics.
Let's do so. Alberto, have a great rest of the week. Have a great Halloween, and let's talk soon.
Thank you.